We're going to look at Zoom video conferencing. And what I do in my videos is I run my discounted cash flow model to figure out the real value of a company's stock. And then I look at the financial ratios of that company and compare them to its competitors. I do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $71.1 billion. And let's see how much they're trading at. $252.18, so that's one share of stock. Let's pull the free cash flows. And the way you value a company is you estimate the future free cash flows. Then you discount that number back to today's value. It's good to see they have positive free cash flows every year. And now I'm going to pull the net income, which is on the income statement. That's a profit and loss for each year, and they have negative net income for 2 years. And then I'm going to pull the revenue, which are the sales, and their sales have gone up tenfold from 2017 to 2020. In 2020 they had $623 million in sales. The average analyst forecast is $1.8 billion of revenue in 2021. And that's what I put into the model instead of using what the model predicted, which was going to be much lower than 1.8 billion. Let's look at the capital structure. They have no debt. Let's get their current assets because we need to calculate the current ratio later. Current assets are mainly cash, accounts receivables, and inventory. That's $1 billion. And current liabilities is what the company owes within the next 12 months. And that's $333 million. And the equity is assets minus liabilities. That's the value of the company according to the balance sheet. And we need their EBIT, earnings before interest and taxes. That's $12.7 million. Let's look at the capital structure. They have 100% equity. The cost of equity is 13.4%, and we figured that out using the capital asset pricing model. And that's the discount rate we're going to apply to the future cash flows. I projected 4 years of future free cash flows. I also projected a terminal value, which is all years past year 4. And the model I used was the model that would provide the highest free cash flows based off of their prior financial information. And I use this model because of the expected growth this company is supposed to have in the next year or two. So when I discounted those future free cash flows back to today's value, I get a value of the entire company of $9.5 billion. When I divide that by 282 million shares, I get an intrinsic stock price at $34. It's trading at $252, so it's trading at a significant premium. Simply Wall Street has them valued at $90, so a little higher than me. Also way overvalued the stock. Just a few months ago, the stock was trading half of what it's trading at, and it still has the same financials. The only thing that's changed is what people think the company is going to turn into, and it's doing really well. But when coronavirus passes, will it still be as strong and needed as it is now? Also, there might be competitors coming into the market that are going to take their space. They are the number one in the industry, but anything can happen. Let's look at their financial ratios. They have a terrible PE, that's price to stock over earnings per share, terrible price to sales, and a terrible price to book. So to calculate PE, that's stock price, 252 over earnings per share, and that's 9 cents. To get earnings per share, it's net income over shares outstanding. So they're providing a terrible value for this ratio. Price to sales ratio is 114. That's really awful. That's price to stock over sales per share. To get sales per share, that's revenue over shares outstanding. So that indicates investors are willing to pay $114 for $1 of sales. I like to see below 2.5 for this ratio. Their price to book ratio is 85.3. That's stock price over book value per share. To get book value per share, that's equity over shares outstanding. This implies that if the company went bankrupt today, it would be able to give each shareholder $3 in return for their stock. So not a good value there. They have a really high current ratio of 3.3 and a really low ROE. The current ratio is current assets over current liabilities, so it's good they can cover their current liabilities, but they don't need that much current assets. It indicates they're doing things inefficiently. 2.0 is more than appropriate. ROE, I like to see above 20%. They're at 3%. That's net income over equity. So they're providing their equity holders with a poor return. The best way to look at ratios is to compare them to similar companies. And I've done videos on Bell, Canadian company, Rogers, another Canadian company, AT&T, TELUS, another Canadian company, Verizon, and Zoom is here. And if Zoom has a number in red, they're worse than the average. If they're in green, they're better than the average. So the only thing they're better in is current ratio, which is a little bit too high, and debt. They have no debt, which is great. All the other companies are using debt to run their business. So Zoom definitely has a great future, and if sales keep growing at such a fast clip, their stock price will rise higher and higher. But right now, it's a really terrible value, so you got to look to the future of the company. You can't look into the present or the past. So let me know what you think of the video. Thanks for watching.